Hey everyone, Dennis Maynard here with RE Properties. We are just a couple weeks away from America's 250th birthday, and I thought it was the perfect time to sit down and give you a real mid-year check-in on what's actually happening in the Los Angeles real estate market, especially in the Hills areas that a lot of you have been asking me about. So let's start with the big picture. Nationally, we're seeing existing home sales are running around 4.2 million annualized, a modest improvement, but still well below what we would consider a healthy market. California is seeing median prices hovering around $900,000, and here in LA County, we're looking at a median sold price of just over $1 million. But here's what I really want you to pay attention to. When you look at LA County overall, homes that are actually selling are going under contract in about 17 days on average. That's a relatively healthy. But when you look at the homes that are still sitting on the market, the active listings, the average days on market is much higher. In many cases, we're seeing 30, 60, even 90 plus days. That gap is important. It's one of the clear signs what we have right now is overpricing in certain segments of the market. Now, let's zoom in on the Hills because this is where things get really interesting. When we compare Beverly Hills, this is north of Sunset, the Sunset Strip and Hollywood Hills West, and Sherman Oaks, we see some clear differences, but we also see some shared challenges. So in the Beverly Hills market, months of supply is running very high. In some reports, over 9 months. Active listings are sitting much longer than the ones that are selling. We're also seeing a number of properties that have been expired and then been relisted multiple times. The Sunset Strip and the Hollywood Hills West are showing very similar patterns. Elevated inventory, longer marketing times, and properties that just keep coming back on market. Sherman Oaks overall looks a little bit more balanced than Beverly Hills, but when you drill down into the actual Hills sections, areas like Coldwater Canyon, Beverly Glen, Camino de la Cumbre, you start seeing many of the same issues. Properties are taking longer to sell and in some cases struggling to move at all. So what's driving this? Well, a big part of it is what happened after the Palisades fire. Buyer psychology has shifted. And a lot of people who used to want to be deep in the hills are now thinking twice. And insurance is playing a major role in that decision as well. Post-fire, we've seen insurance pressure across these hills markets. Premiums have risen sharply in many cases. Some carriers have pulled back from high-risk areas. A lot of homeowners are being pushed onto the FAIR plan, which is more expensive and more limited in scope. And buyers are now routinely walking away from deals or never making offers in the first place once they actually see what insurance is going to cost them. This isn't just a sales story. The leasing market in the East Hills area is facing similar headwinds. In Beverly Hills, we've been running over 100 active rental listings in recent months. And properties that do lease are taking a long time. Median days on market is around 60 days for leased homes. And we're seeing quite a few rentals that have expired and been relisted multiple times. Now, the Sunset Strip and the Hollywood Hills are showing the same pattern. Higher inventory and longer time on market for rentals. Even in Sherman Oaks, while the overall numbers look better, the Hills pockets are seeing landlords struggle to get properties leased. Many homes are sitting longer than expected, and some keep on cycling back on market. Look, there's an old quote that's been attributed to people over the years. The definition of insanity is doing the same thing over and over again and expecting a different result. A lot of sellers and landlords right now are still pricing and presenting their properties in the same way they did 2-3 years ago. And then they're surprised when they're not getting the same results. The market has changed. Buyer and tenant expectations have changed. Insurance has changed. And if we're not adjusting our strategy, we're going to keep seeing the same frustration over and over again. Now, I quickly want to touch on the multifamily side because I know a lot of you are investors. Class A multifamily in LA right now is generally trading at cap rates in the mid 4s to low 5s. Class B is running in the 5 to 6.5 range, and Class C is running higher than that. These are just broad ranges, and every deal is different. But if you want to talk about specific assets or what realistic pricing looks like in today's environment, I'm happy to walk you through that. So, what does all this mean? Well, it means that in the hills right now, success is going to come from being honest about where the market actually is, not where we wish it was. It means understanding insurance is affecting buyer and tenant decisions. It means being willing to adjust pricing and strategy instead of just relisting the same property with the same approach. That's exactly what I help my clients do. Whether you're thinking about selling, buying, or leasing in Beverly Hills, the Hollywood Hills, Sherman Oaks, or anywhere else in LA, I'm happy to give you a straight, data-driven assessment of what's really happening with your property or the one you're looking at. Now, you can reach me directly at dennis@soldbyaria.com or call or text at 310-770-8815. And if you want to stay on top of what's happening in the LA market, hit that subscribe button and turn on those notifications. I'll keep giving you these real, no-fluff updates. Thanks for watching, and I'll see you on the next one. Happy birthday, America.